Thanks, Kevin, and good morning, everyone. While the panel gets wired, again, it's all about IT these days, and take their seats, I thought I'd just give you a little overview of what we're trying to do. This first panel of the conference usually deals with kind of what's going on in MedTech venture. It's had a variety of names. Last year, we tried to focus on the early stage funding gap, and I think today, I think we're going to focus on just what's going on overall. Obviously, there's a food chain here, and one of the bigger issues, I think, in the industry is the fact that the limited partners, the investors in venture funds, are having second thoughts about venture capital in general as an asset class, and more specifically, healthcare, and then within healthcare, MedTech. So no matter where you are, the crosshairs are on MedTech right now. So I thought, let's focus on that. We have a great panel today. These are the investors who are on the front lines, who are busy. On that slide you saw the active investors for 2011. These four investors represent a good deal of that activity. So we're fortunate to have them today. As Kevin mentioned, I have left 3Arch since the last conference, and setting off with a new fund with a completely new model called Osage University Partners, looking at partnering with universities and capturing ongoing investment capabilities with university spinouts. I think as you look at the decreasing R&D dollars being spent in corporate America, universities are where most of the discoveries are now occurring, and with the universities starting to realize that although their primary mission is research and education, there's a growing desire to try to commercialize some of those discoveries. And many of the universities have reinvigorated a broader tech transfer operation. I was over at the University of Minnesota yesterday at their venture forum and was amazed at the quality of the companies that they're spinning out and how robust a program they have to try to foster innovation and move these discoveries from the bench to the public good. And it's across all areas, not just healthcare, but very impressive effort. For those of you in the community, you probably know that already. But at Osage, we've partnered with 48 of the leading universities in the country and have looked at and made investments both on the physical science and life science side. So it's a startup, it's a new fund, we just closed it, and all these years I've been telling entrepreneurs to go out and follow your passion, and I figured it was time to put my money where my mouth is, so to speak. So that's been exciting. So what I thought I'd do, as opposed to giving you detailed intros to the panelists, the bios are published, they're on the website, and they're in the materials. But what I do is just ask each of them to give you a quick intro to kind of their fund and where they are, what they're looking at, and how they're dealing with the current changes in the landscape. So I'm going to try to move this a little bit so you guys over there can see a little better. There, John, if you want to pull up. So to my left is John Ryan from Onset Ventures, Lisa Suennen from Psilos, Juliet Bakker from Longitude Capital, and Mike Carusi from Advanced Technology Ventures. So John, if you want to just start, given you're the closest, although we'd like to do ladies first, if you could just give folks a little introduction to your fund and kind of what you guys are up to these days.
I can't believe we started off by you calling me a lady.
Nobody needs to know.
Yeah, so sure. Onset Ventures has been around for about 28 years. Onset has always invested in both information technology and medical technology companies. Generally around 50%, 40 or 50% medical, but it depends on the number of deals that we find that we like in any sector in terms of the split. Onset is well known for its early stage investing. So traditionally about 70% of Onset's investments are in seed or Series A companies. The other 30% are opportunistic investments at any stage, and mid or late stage. At Onset, we focus on something we call venture craftsmanship, and that means that unlike some other early stage investors, rather than sprinkling a lot of investments around, we try to do a fewer number of good, high-quality early-stage investments, and then we try to help those companies along as much as we possibly can. Really at the board level, we don't get involved in day-to-day management, but from a board level, we try to help make those companies successful as much as possible. Within the medical area, we do primarily medical devices. We'll also do some drug delivery and diagnostics that are device-y in nature. We don't do drug development biotech type companies. We've got 3 partners, myself, Leslie Bottorff, and Rob Cooling. And you know, we are very optimistic about the future of healthcare. But I guess we can talk about that a little bit more in a few minutes.
Hi everyone, I'm Lisa Suennen. I'm a partner with Psilos Group, and we're about a 14-year-old fund. We invest broadly in medtech and healthcare IT and healthcare services. We tend to invest pretty late stage in companies with 5 to 10 million in revenue and take pretty big stakes in the companies, get very actively involved. Our focus across all these sectors, including medtech, is to find companies that have figured out ways of improving quality and reducing costs, with a significant focus on reducing costs, reducing inflation in the healthcare system, and aligning the financial incentives of patients, payers, and providers. So we take a very healthcare economics approach to what we do. And we're located in California and New York. We have 5 partners focused on this area. We probably have about 45% of our total capital under management in the medtech sector.
So I'm Juliet Bakker, and I'm a co-founder of Longitude Capital. So our team actually founded the healthcare practice at Pequot Capital in '97. And Pequot Capital was a large asset management firm. And then the practice there was combined tech and healthcare. So we've seen what it's like to live in a practice that has combined technology and healthcare practices. In 2006, our team left Pequot and formed Longitude Capital. We were really very focused on having a healthcare-only fund, so we raised our first fund, which was a $325 million fund. That fund is now almost fully invested, and we've already raised and closed our second fund. And we focus exclusively on devices and biotech. We've always had an intention of allocating the capital about 50-50, and that's also how our human capital is deployed, and we have some very specific reasons for that allocation that we can discuss a little later. In terms of medical devices, historically we've been stage agnostic, so we are willing to invest at any stage of a company's development. We've led a number of Series A investments in companies that you know, and we invest also in later stage companies. And the thinking is really that we don't want to do exclusively early stage, because one of the prime tenets of our fund and one of the promises we make to our LPs is that a key investment objective is to return capital from any given investment within 3 to 5 years. So if you have a whole portfolio of only early stage companies, whether they're device or biotech, that's unlikely to happen. And so in parallel, on the biotech side, we invest exclusively in later stage companies, in companies that have drug assets that are very well characterized. We have offices in Greenwich, Connecticut, and Menlo Park, and we have 6 managing directors and a number of other investment staff, so we total about 10 at this point.
And I'm Mike Carusi, general partner with ATV, and we too are a balanced fund, so healthcare and IT, as well as clean tech. Healthcare is about 50% of what we do, and then within healthcare, it's about 50% devices, 50% biotech. We are by and large early stage. About 3/4 of what we do is Series A, Series B, early stage investments. And then within that piece, we are actually remain very focused on therapeutics, even devices that have a therapeutic feature or orientation, and very much focused on the innovation side of the house. So, you know, within devices what we're looking for is what we've termed devices that are playing in billion-dollar drug markets. So we're really looking at devices that may compete with drugs, that may play in drugs of that size. I think probably 2 good examples are Ardian that we were involved with, that was in the hypertension space, GI Dynamics, it's in the diabetes space. So we're really looking for companies that can be very, very disruptive. And on the biotech side of the house, a similar orientation. We look for platforms where you're generating multiple shots on goals. And again, the objective here is to do things that then have high strategic value and relevance, so that, to Juliet's point, although they're early, you actually have the opportunity to exit sooner because the strategics will come in earlier. And then there is a portion of our fund that we will focus on what we call special opportunities. That can be a whole gamish of things, but again, the goal there is really to get in and out in a quicker period of time. So that's our makeup.
Great. Obviously, the industry is undergoing a great deal of change, both at the venture fund and firm level, and then among the startups. And I wanted to ask, what do you think is probably the most significant change you've seen in the medtech landscape over the past year or so? And I'll come back to Mike with that.
Well, so I think the faces are changing. I think there is a shakeout occurring across the board, and it's occurring in venture. The venture fundraising climate is very difficult. So as you talked about earlier, Bill, we may want to continue to invest in medical devices. The question is will our investors allow us to continue to invest in medical devices? And I think that's where the bigger challenge is right now. I think there is a quick drift back towards the IT side of the house. So we are, competing with the Instagrams where you can make, $1 billion in 11 months. And the questions that we are asked is, where can you do that within healthcare? And I think we would all argue that we're, if not in a bubble, entering a bubble again in some of those spaces, but that makes it very challenging for all of us. So, I think as a result, we are trying to define our strategies and to define what we're doing so that we can show to our LPs that we can make dollars that compete with some of these other investments and make returns. And I think that's creating a lot of shuffle in the industry right now.
Lisa, do you have a different perspective or anything to add?
Yeah, I think two things. One, I've much to the shock and surprise of all the healthcare IT nerds out there, they've become very sexy as compared to the medtech folks that used to be the sexy ones. I've caught since we do both and always have, I've gotten calls from numerous medtech investors over the past couple of years saying, how do we start investing on the healthcare IT side? So I think the cycling of dollars from one side to the other is really interesting, and the search for things that combine those two areas is certainly growing, and evidenced by some of the stuff Qualcomm and some of the others are doing out there. And the other thing is, I think conventional wisdom used to be, stay out of Europe at all costs, and that's become now, the focus for many of these companies is get into Europe as fast as you can, or other countries outside the U.S., and forget the U.S. Hopefully, you'll never have to bother. So I think those are two pretty significant shifts that we've seen.
Getting back to healthcare IT, and we've obviously hear about a lot of investors shifting their focus to healthcare IT. Do you think, you've done it now for a while, are the skill sets the same? I mean, can you just shift from doing medtech and biotech investments and kind of what I'll call wet science to looking at healthcare IT, or is that a different experience and skill set to invest in those spaces?
I think it's a combination. I mean, I think the skill sets, the rigor of just the venture process is very similar. But I think there's a much more significant emphasis on healthcare operations, how hospitals work, how money flows through the system reimbursement-wise, not just getting a code, but how does it get all the way down to the level of when, Blue Cross Blue Shield of Minnesota will pay for it, and who will pay for these things. It's just that side of it is much more significantly amplified, and I think, it's learnable certainly, but it's certainly not the thing most medtech people think about first.
And
yeah. I'd say it's a really different skill set. At Onset, since we do both IT and medical investing, we've been active in the healthcare IT space for the last couple of years and are evaluating it in great detail. And for medical investors, frequently we invest in proprietary products. So intellectual property is really key. You want something that has strong patent protection and can't be easily competed with, as opposed to healthcare IT, where the barriers to entry are extremely low. And so in any given sector within healthcare IT, there are loads of competitors. And for a med tech investor, I think that's frequently a difficult thing to get comfortable with. That's one example of difference, but there's many others. The milestones that you look to build with these companies are substantially different. The healthcare IT companies are commercial milestones from the very beginning, rather than clinical development milestones, et cetera. So I think it's really a specialized area.
Hey, Bill, just I was thinking about your question earlier about what's really changed over the last couple of years, and to add to Mike's point, it's absolutely true that capital is scarce, right? So it's scarce coming to us, and so you see an immense fallout in the venture capital industry of funds that groups that simply cannot raise funds, and therefore it's scarce coming to the venture industry. And I think it's just worth remembering that if you look at the returns from the venture industry over 10 years, the VC return is 2.6%. And the S&P 600 is 2.8. And early stage deals is 0.9. Late stage deals is 6, 7, and multi-stage, which is where we operate and why we operate that way, is 4.5. So, the investors have other places where they can put their money. They can put it in real estate, they can put it in forestry, they can put it in distress, they can put it in oil and gas, they can put it in China, they can put it in Brazil, they can put it anywhere. So when they see these kinds of returns for the venture industry, and then in particular when they see the kinds of returns that the healthcare industry has generated, they're not doing their pension funds or their university endowments or their school endowments any favors if they're not allocating the money in the best way possible. So there's a very real imperative to perform. And if you don't perform, you don't deserve to get the capital, and that's really, I know it trickles down to you guys, but the responsibility rests with us to deliver the best possible outperformance to the investors, and ultimately, those investors also end up being us personally, right, because we have pension funds and so forth. So it's really all about performance, and the category has not done well, and it reflects the risk in the category. For every Instagram and whatever, there's lots and lots of money lost. So that's one of the big things that's driving capital scarcity. And then there's the economy. We haven't talked about the fact that I think we were all very surprised by the impact of the economy on utilization rates in hospitals, on numbers of elective and not so elective surgeries being postponed, on the reduced number of visits to primary care physicians, even for pediatric visits. I mean, the economy's had an enormous impact on the spending in healthcare. It has an enormous impact on how CMS is looking at things. So from our perspective, something needs to be highly differentiated, more cost effective, significantly better clinical outcomes. Non-inferiority really doesn't count anymore. That's right. So the economy is an enormous influence on demand. CMS appropriately is being very cost conscious, so we have to look more at differentiated technologies, which is what Mike talked about. And now if you look at the CMS data and what the hospitals are reporting, utilization's flat. The economy is improving, but utilization is not really expected to be significantly better. So from those macro events, we have to operate within that paradigm, and it's not going back.
And I think it's worth noting that if you look at the average insurance payer, not CMS so much, but the commercial payers, they approve, and there's variation, but they approve on average 1 to 4 devices for new reimbursement a year. There's a few outliers, some might do 10, some might do none. So I think at Regions Blue Cross, they told me they'd done 1 in the last 15 months, 1 approved new device for coverage, despite whatever CMS says they'll cover. So that's a really important point to think about when we're investing and we're thinking about what the payers are going to do. CMS may cover it, but if the rest of the payers aren't going to cover it for 2 or 5 years or ever, it's a tough market.
But I think it's an important point, because so this is all the bad news. So what's the good news, right? And I think the good news is
we're all getting old.
But I think there is good news. The unmet needs remain enormous, right? And the unmet medical needs remain enormous. The economic needs remain enormous. I think we all deserve some blame, because I think if you look over the past 10 years, our view is we funded too much incrementalism. So we funded stuff that was a little bit better. Well, why did we do that? Well, we all bitched about the FDA and it's too hard. So we ended up not doing PMAs, right? Let's go do the quick 510Ks. But they were incremental. And what I think, at least we believe, is that people don't really care about incrementalism. What they're going to pay for is stuff that is truly disruptive, truly novel, and truly better. And so when we look at what's changed maybe the most over the past year or two or three, for us on the therapeutic side of the house, it all comes down to the data. It's all about the clinical data. And if you don't have good, compelling clinical data, you're sunk. And so what's different with Europe, at least in our minds, is, you know, partly there's an outlet to go to Europe or other markets for revenues, but there's also an outlet to get more clinical data and to get good clinical data. And not worry about the FDA, not worry about the US. Go do a randomized clinical trial, not just a feasibility study in Europe. Generate the data and prove that your product, be it a device or a biotech or, you know, drug, whatever it is truly differentiated and addressing some significant unmet need that payers, clinicians, patients, and ultimately the strategics will care about. And that's, you know, been our orientation and continues to be it going forward. So we actually think that once we get through this difficult period, that the next 10 years are going to be better than the last, because some of this stuff does have to clear out of the system to get better returns going forward.
One just administrative point is on the tables are 3x5 cards and pens. And if you have a question that you'd like me to ask our panelists, please feel free to write it and just raise your hand, and IBF will have folks wandering through. And that'll be true for the balance of the day. We'll have some Q&A toward the end here as well if you want to stand up with a mic. But please avail yourself of our panelists if you have any questions you'd like to ask. So the other question then is, do you think with this focus on late stage, and you talk to investors today and the data bear out a focus on later stage, quote, de-risked opportunities, you know, arguably at early stage valuations. I mean, do those opportunities really exist or not?
So we're going to have maybe a different view here. I think the good ones are hard to find. I think, so if we're successful in our strategy, late stage guys will never see these deals. And if you look at Ardian, late stage investors didn't see it. GI Dynamics late stage investors didn't see it. Because our goal is to syndicate it with 2 or 3 other like-minded groups early on, have those groups carry through the Series A, maybe the Series B, partner up with strategics, maybe 1, maybe 2, maybe 3, and again, then use that as a way towards an exit. So personally, I think there are opportunities, but I think they're diamonds in the rough. I think they're hard to find, my view.
Well, we're seeing some. They're good ones are hard to find for sure, but they're definitely out there. And there's certainly a predatory nature to it, though, in a way. I mean, you're oftentimes finding the stuff that funds started and couldn't continue to fund, and so, you know, other folks have opportunities to step in. But there's also, I think we're seeing a lot of opportunities with companies that flew under the radar for a while, took a little while to get going, and turned out to have something really good and need capital for growth, and they were funded either through alternative means or through lesser-known funds. So we're definitely seeing opportunity out there. It's just not at the same level of volume that you see the early stage.
And it's also kind of risk adjusted according to capital, right? Because you're absolutely right. There's very difficult to find a really compelling story at any stage. Yeah. So it's certainly difficult to find a late stage story that's attractive, but it's all out there. It just depends on you looking at it and how you assess it. And the way we think about it is, you know, if we're going to write a check for $20 million, by definition, it'll be a later stage company. And by definition, the risk has to be lower because it's an enormous sum of capital. But if we're going to write a check for $2-3 million, I'm not saying that's an insignificant amount of capital, but you can afford that loss in a $350 million fund far better than you can the loss of 20 or 25. So for us, when we think about how do we evaluate risk in an early stage deal, the number one thing that's always worked for us is if an entrepreneur or Series A gets created in the context of very compelling lateral clinical data, so that you can look at either a surgical equivalent or a drug equivalent or research that was done 20 years ago that has just been unearthed and that somebody really creative has focused on, and the person can make an incredibly compelling case for there's a really high likelihood that this is going to work. And then it doesn't feel that risky. So from a Series A perspective, that's the kind of situation that we find very attractive, where there may not be any human data. You may even be preclinical, but there are all kinds of other science-based reasons to really have profound conviction that this is going to work. And then it has to be chances of more cost-effective and so on and so forth. But that really strong scientific basis has to be there, and then that reduces the risk.
I agree with that, but I don't know if it, where I would push back is it less risky or is it just different risk? So
different.
Because now, if you weren't successful in selling your early stage company based on the clinical data early, now you're out trying to build a sales force and you're fighting the reimbursement battles. I would argue it's still risky, it's just different risk. You don't have the clinical risk anymore, but whether or not you're going to get paid for it, and you can compete with the other players in the space. So I agree. Look, there's lots of ways to make money, even though we haven't figured out how to do it over the last 10 years. But I think but I think the issue is I don't think it's a cure-all for the industry. And what I worry about is a lot of our brethren are now saying, well, we're going to go do late stage now because that's where you can make money. Yes, partly, but I don't think it's the answer, and it's not going to cure all of our woes. I think a lot of these deals, frankly, are crap, and so there's a reason they're late stage. It's because nobody was interested in them. So,
but I also think as the late stage deals flush through, I think it's kind of a market-driven opportunity now, because of the challenges as those late stage deals either go away or get done. What's behind them is a challenge, right? I mean, there's been a dearth of early stage. At this conference, on this panel, for the last few years, it's been, where's the early stage investment? The companies that are fortunate enough to get money in this environment, in the 3 to 4 year time horizon, are going to have tremendous scarcity value, both to investors and to acquirers. So I think, to persevere and find a way to secure financing, if you can do it, just by virtue of that alone, gives you a big step towards success. I wanted to change direction a little bit. We've heard a lot about the increasingly conservative and unpredictable nature of the FDA. A lot of companies have looked to Europe to try to clinically validate their technology. Are you looking at companies domiciled abroad, and have you looked at sort of non-FDA risk opportunities where companies are trying to skirt the FDA altogether by looking at OUS markets, or technologies like aesthetics where the FDA risk tends to be a bit less, or consumer?
Yeah, well, of course, I think everybody's trying to skirt FDA risk if they can.
Well, so tell us how you're doing it, John, because we'd love to know.
It's been terrible for the last, many years.
No whining, no whining.
Yeah. Well, I was just about to say.
Just tell us how to get around it.
I think actually, all these things are cyclical. Like VCs running to early stage and running to late stage, and so forth. And so is the FDA, right? In the early 90s, the FDA was awful, and many venture firms dumped their medical investing practice strictly because of the FDA and how high the hurdle was and how difficult it was to mitigate that risk. That led to the cycle turning. The FDA got a little better, and we had a big boom in medical device companies in 1996 with lots of IPOs and success in the latter part of the decade. I think that's the case here. So the FDA continues to be extremely difficult to deal with, although there are positive signs occurring now, and I'm sure that you'll hear later about the legislation that's being passed through several congressional committees just in the last few days with FDA reform provisions in them that I think will help. So I think the FDA is going to get better, and so for a venture firm to entirely shift its strategy and say we're only going to do late stage because the FDA and reimbursement sucks, I think that's short-sighted. It's the investors that stay true to their strategy and invest through the cycles that wind up taking advantage of things when they cycle upward. Having said that, if you can avoid FDA risk, that's great. And we are seeing many of our portfolio companies are commercializing in Europe first or other parts of the world, and then the U.S. strategy is secondary, which is a huge change over the past. We're also seeing lots of companies from outside the U.S. that are emerging, And frankly, you know, the U.S. is losing its grip, I think, on medical technology innovation because so much more innovation is happening outside the U.S. and so many companies are moving their development programs there.
Yeah, I mean, we've invested once in a device company out of the country, and while it's turned out well, it's difficult, I think, for us because we don't have people out of the country. I mean, it really impinges on the ability to have a hands-on approach with your portfolio companies unless you're physically located nearby, I think. So I think that's, you know, an interesting consideration as you see so much innovation happening in India and China, and it's certainly the explanation for why so many firms are putting stabs, you know, overseas. But I think there remains a bias towards U.S. companies, or at least U.S. penetration in the market for the companies that I've been involved with that haven't yet come to the U.S. with their products. It's very difficult for them to find follow-on funding because while everybody knows they are better off starting overseas and getting some revenue and getting some traction, there's still this sort of discomfort with, oh, well, it's only been sold out of the country, and, you know, show me revenue in the country. These are obviously later stage deals before I can get excited about it. And it's a real catch-22 for folks who want to raise their ground now to enter the U.S. and do their FDA work.
Juliet, Mike, do either of you invest in companies domiciled outside the U.S.?
Well, we have one which is domiciled in Ireland, but it's publicly traded. So a third of our portfolio is invested in publicly traded companies. And I think it's really important what John says is when people shift strategy, it's fatal. You should either do what you've always done or go home. Because retooling with the same team is really hard, or else you hire a whole new generation or a whole new skill set of people.
So that's the don't evolve or die strategy.
This is the, you know, we've always done all stages, and we've watched this. Now we're doing late, and we're like, well, you know, we'll see how that works. Just shifting strategy is just generally speaking not a good strategy, but we, for the same reasons as Lisa described, are not prioritizing investments overseas. Most of us have worked overseas, and it is very easy to underestimate the challenges offered by time zones, geographic distance, cultural differences, professional priority differences. And so it's not that we wouldn't do it, it's just that we haven't prioritized it. We feel that there is a very strong innovation community in the US, and we just have to work harder to find the right companies within the US. And I just want to say a word about the FDA, because there's a lot of FDA bashing, but I can also really recommend that people, when you do your work, that you do it with a mindset that's respectful of the FDA. I mean, at the end of the day, they are here to protect all of us. They may or may not be super efficient at all times, but there was also a mentality of a lot of companies until recently that, you know, they just wouldn't always bother to answer the questions that the FDA offered straight up, and that they would offer the answers that they wanted to offer, not the answers to the questions that the FDA asked. And in all fairness to the FDA, I think the better part of valor is to respect their requests and really take them seriously. And you know, there's been a culture from the regulatory consultants and other people to just give the FDA back what you want to give them. But the reality is they asked for something, and if you don't give it to them, they're going to delay you. So I just encourage all of our companies to work very closely with them and just answer them as directly as possible.
Good advice. Switching for a sec to allocations within healthcare. For those of you that do both therapeutics, sort of biotech, biopharma, and devices, leaving aside IT for a minute, are you planning to, or have you seen a shift in the relative allocation of resources within your fund between those two areas?
So we're still 50-50. I mean, I think more broadly there's been a shift. It seems, at least, that, you know, again, some of our peers are shifting away from medtech to either healthcare IT or biotech. But we continue to be 50-50, and we almost don't, again, delineate between devices and biotech. Our view is, again, therapeutics and what's the best therapeutic, be it a device or a drug, for a particular disease or indication. And so we try and look at it more from a disease point of view. And then if it's a device solution, terrific. If it's a drug solution, terrific. We're almost agnostic in that regard.
It's the same for us. So we've been 50-50 going back to 97, and one of the advantages of having resources and capital for both areas is that the biotech and the device markets don't move in tandem, right? In terms of valuations, in terms of discovery cycles, in terms of capital availability, and we're in a cycle on the biotech side now where there's very low capital availability, there's very significant unfunded needs and outstanding opportunities. And syndicates have run out of money much faster in their biotech deals than they have on the device side. What we've seen on the device side for the last 3 years, not wanting to say that all these late stage deals are the word that you used.
All of them were.
But what we've seen is a lot of syndicates carry their deals on the device side, because carrying a device company for another year is a $10 million experience, not a $25 million experience, which it is on the biotech side. So on the biotech side, the syndicates have become weaker faster than on the device side, where a lot of people have kept carrying their companies, and we think that's about to shift now, because how long can you keep doing that on the device side? So that's why we like doing both, because we're very value oriented, and we try to find the best opportunities in either side.
Yeah, I mean, syndicate risk has become a new term, where in the past you really wouldn't worry about your venture investors running out of money or funds going away or partners disappearing. But I think today that's a real concern, in the idea of a small Series A followed by a medium Series B followed by a larger Series C and beyond. We're seeing, early stage, compelling early stage opportunities, if they are funded with large rounds that are tranched and essentially combine what would have been an A, B, C even, with 4 deep-pocketed groups around the table. So at least you can look around the table and say, all right, if things work out, we'll have the capital to take it forward. And we don't have that risk, which I think has sunk some companies and caused some boards to behave less than rationally. So I think we're seeing that more or less across the board.
Totally agree. And and again, it's not just the fund; it's the particular partner, because there's changes at the fund level, but there's also changes at the partner level. And I think all of you and certainly all of us have been involved in situations where, if a particular partner leaves a firm, more often than not, the deal tends to get orphaned. Not always, but you lose your champion, and that's usually not a good dynamic. And so it doesn't always happen, but my experience is more often it happens. And so it's really important to also know who you're investing alongside, and what's their standing within the particular firm, and do they have the ability to fight for resources? Because again, capital is scarce, and within a venture fund, you've got budget, and where's that budget going to go? And so really, you need to almost take all of that into consideration as you're building a syndicate.
But at the same time, I think, wouldn't you think that a lot of that risk will have shaken out by the end of next year?
Yes.
Because the survivors will be the survivors. They'll have, each fund will have, somewhere between $250 and $350, $400 million. They will have won the vote of their LPs for another fund. That fund's going to be in deployment for 5 years. So as you go forward and you look for capital, I think that risk is going to diminish, because the industry will have shaken out by that time.
Yeah, I think I think we're dealing with it now, but yeah. I agree with that.
I really disagree with that, because I think the syndicate risk has been a long-term issue. I mean, I think it's amplified in the current environment for medtech companies, because there's a lot of shakeout going on. But honestly, I think one of the questions entrepreneurs forget to ask a lot of times is whether companies have dry powder, where they are in their cycle. I found, and one of the ways we deal with this is by being somewhat antisocial. We don't do a lot of syndicating, because we find that there's always a situation where the other funds, regardless of the medtech cycle, have other issues, have other priorities, and get out of sync incentive-wise with their co-investors at various times, either due to the cycle of fundraising they have. They need to exit now for something to put points on the board or what have you. And it really, I think it's a perpetual issue that needs to be thought about when you're raising money for a company.
But so and you've done that. I mean, Psilos has done a number of those type of deals. What about the flip side, where you have one investor and you're sort of tied, you know, sink or swim? You're kind of chained at the ankle.
I mean, it's clearly a different kind of a risk and a very real one that we faced. Although, you know, we try very hard. I mean, we have a little bit of an advantage since we're later stage. You already know the binary risk is likely gone of whether the thing works or not. But now you're dealing more in more execution risk, reimbursement risk, and things of that nature, as Mike was saying earlier. And you know, for us, that's just the way we've decided. We're kind of all in or all out. And you know, when we put money into a company, we reserve enough to take it what we believe to be all the way or nearly all the way to the exit, whatever that turns out to be. So we may have longer holding times for some of these companies than we might like, but you know, it's borne out. I mean, for us, you know, we have maybe 10 to 15% of our companies don't make it, which is a pretty decent number for in our experience. And so the risk for us of control has been worth the balance against the risk.
I found my late stage opportunities.
Yeah, I was going to say.
I think the syndicate environment is changing also in terms of just different investors out there. So you know, it's hard to manage a syndication risk with the typical VCs because a lot of the usual VCs are going away, and you know, it's sometimes hard to predict which ones those are going to be, and it takes a venture firm a long time to go out of business. So, you know, I hope it shakes out over the next 12 to 18 months, you know, maybe or maybe not. But we are seeing a lot of new and different kinds of investors in the marketplace. So, for example, with some of our later stage companies, we're having firms invest that maybe we wouldn't have worked with in the past, you know, LBO firms or hedge funds or other folks like that. We're seeing a lot of smaller funds, you know, kind of $50 million funds popping up these days. New kind of models like Osage that Bill did.
Osage.
Thanks.
Right. So I want to leave. I just want to leave time for questions because we are going to run out of time here in a little while. We've got lots of questions and things we can talk about, but if anybody has any questions for our panelists, I want to make sure we have time to get to them. So don't be shy. There's a couple of microphones that Craig and his team have, and then there are the cards. So just raise a card if you have one, or raise your hand if you'd like to ask a question.
Maybe just while people are thinking about those, Bill, I think one important point to talk about is reimbursement. And of course, everybody in the room is familiar with the reimbursement challenges and risks. But as I mentioned, you know, I agree with Juliet partially on the FDA point. You know, I think you do need to be respectful, and of course we all do want regulatory agency to help us have safe devices. However, I think frequently we get a little too polite when we talk to the FDA. You know, when we talk to each other individually, we talk about the real problems we have with the FDA, and then when we get in a public forum, we you know, say it a little too lightly. You know, the FDA really has been a serious problem for us. As I said before, I think that's getting better. But the next big challenge, I think, for all of us, we really are going to need to sort out is reimbursement. And so I would encourage everybody to continue to think about the FDA and try to work on that, but also to start thinking more and more about reimbursement, because it currently takes, you know, years to get most devices paid for, and that's just when we talk about the fact that, you know, venture firms are going away and our industry shrinking. You know, that's the problem. That's unsustainable for us. We can't build companies and then take an additional 3 years to try to, you know, figure out a way to get the product paid for. So I think that's something that we all need to try to work on together.
I mean, Lisa, you've invested in new insurance companies and started them, and obviously are a payer by proxy. So, you know, I think, and you and I've talked at length about the fact that many medtech companies and even investors really don't address the reimbursement questions until too late into the process.
Yeah, I mean,
I don't know if you want to comment on that, but I think it's helpful.
That would be my number one piece of advice is when you think of your idea, go meet with the medical directors of United Healthcare and Humana and Aetna and Blue Cross Blue Shield or whatever, because they have an opinion and they will tell you what kind of data you need to produce. Talk about data oriented, where these guys are very evidence-based, you know, and also very economics-based. If you come in with something that's an incremental whatever, and it doesn't just slide in under an existing code, you will never get it paid for by them. So you need to go and talk to them, and they're very accessible oftentimes and interested in collaborating and innovating, and some of them even invest to a certain extent in new technologies. But they have committees that decide on what technologies will get reimbursed. They meet irregularly, if, you know, and not often. And they're very rigorous, much more rigorous, I think, in some ways than even CMS is about what gets paid for.
And you know, the payers are key to this because they essentially, you know, it's not a stated policy, but they essentially have policies to not pay for new technology because they refuse to pay for CPT3 codes, although the AMA continues to issue new technology CPT3 codes. So that system is broken in that way. But it's also, you know, the physicians in the industry, the physician politics make it extraordinarily difficult for companies to get the coding that they need. And so I think the physicians make things as challenging as the payers.
Well, I think for the first time, you know, in our country's history, more than 50% of physicians are employed, you know, by systems. You know, they're becoming staff model employed providers. And so for the first time, these are physicians that will make money by saving money instead of by doing more services. And it's a huge macroeconomic change that needs to be taken into account in the development of new ideas and innovation. If you can help payers and providers, and they are now becoming one and the same, make no mistake, you know, in saving money to their system, you will be much more successful than if you're adding an incremental cost to what they're trying to do.
So we had a question from the audience regarding the proposed MedTech excise tax and whether that would have any impact on your investment decisions. Obviously, it affects the corporate acquirers and consolidators quite directly, but assuming that you're making investments in companies that aren't going to have meaningful revenue, but just on the original investment decision, does that enter into your thinking in any way, or is it just blunts the exit valuations across the board to some extent?
I mean, it hasn't affected what we're doing. I do think it's yet one more headwind. You know, it's just one more challenge that our industry faces. And again, as you stack these up, reimbursement, FDA, excise tax, it's just one more challenge that we have to address and answer. And so, is it affecting what we're doing? No, but it doesn't help.
I mean, hopefully, if you know we do things right, then we don't have to pay a whole lot of excise tax before we exit or get liquidity in our investments. So from
but the acquirers face that, and they're working in their modeling
That's
for
correct.
what they want to pay for your asset.
It's going to lower values,
but it's more of a headwind. I would agree, Mike.
That is
And
true.
it raises the capital requirements for later stage companies. You know,
Yeah.
I have a company that's got about should do about 50 million in revenue this year, and they're going to have to pay a chunk of change, you know, and it's a difference between hiring more salespeople and paying that tax.
And it's not on profit; it's on revenue, which
it's on revenue.
which is a problem.
So another question, which I think gets to the guts of it, is you know, for early stage class 3 PMA devices, where should an entrepreneur look for money? They've got an idea; it's clearly a big new idea, so it's a PMA.
ATV.
Yeah, Mike.
And
ATV,
and
okay.
Longitude. We do half of our device investments are early stage investments, so it's
Yeah, and I think
appropriate
there
place
is
to go.
more of an appetite for a truly transformational big idea. I mean, early stage, you know, the stats show it's down, but the deals that are getting done are really the brave new world kind of big ideas. And I do think there are dollars available, but not incremental ideas. So I think you know, for the funds that are getting raised, you know, that's an area that people realize that there will be some scarcity value.
But there's a lot of subtleties to it, right? So
Yeah.
it isn't just if it's a PMA or not. I mean, there's a whole host of questions we ask ourselves. Can you get early proof of concept? Can you get clinical data that will help de-risk it? So PMA in and of itself isn't, in my mind, good or bad. The question comes down to, as you start to peel that onion and you look at the various layers, you know, how can you de-risk the company along the way so that you are comfortable writing that next check if you're not successful in selling it early? And so, you know, all of that has to be factored into the decision, and that's why, you know, these deals are a little bit of like dancing on the head of a pin. There aren't many attractive deals because as you really start to work through these second order and third order and fourth order questions, it's hard. And so PMA doesn't, we don't run from that, and in fact, that's probably where the breakthrough opportunities are. Mm-hmm. You're going to have to get the clinical data anyhow. I mean, the days of a 510K with no clinical data, in my mind, are gone. So it becomes whether or not there's an FDA path that you can navigate with that PMA.
Yeah, I think that the net is that, I wouldn't shy away from the venture community. I think we are going through a reorganization, and the funds that, as Juliet said, our survivors will have fresh capital, and those are the kind of ideas that meet the various criteria. That's what people are looking for.
And then I think if you have a good idea, all of you know a CEO that's been very successful in this space, or a venture capitalist that has backed that CEO, and I would network, and network because there will be at least 5 really high quality groups to whom you can show your idea. Each group has different partners to whom you could show your idea. Each partner has different biases, as does each group. If a partner just lost $20 million in that same space,
what are you looking at
6 months ago, I'm not looking at you, I'm not looking at you, then it's very unlikely that they're going to be willing to go to their partnership and say, remember the money I lost in this space? Well, I'm planning to do something in the same space, but on a different deal. I mean,
you can't be wrong twice, though,
and not keep your job, I think. But so I'd really encourage you all to network, because there is in fact plenty of capital for really good ideas, and we're all really interested in funding them. So network, find out who the groups are that have capital, find out who are the groups that have fresh capital, because to Lisa's point, you don't want to be necessarily at the tail end of a fund, because you don't know if they're going to be able to raise again. And that way, if it's a really differentiated idea with strong potential, it'll get funded for sure. Because the rest of us, you may think it's hard for us to deploy, it's easy for us to deploy our capital. It's not.
One of the big changes also is the level of capital efficiency. One of the problems in the venture industry that occurred, I guess in the kind of late 90s and through the 2000s, is that companies started requiring more and more capital, and venture funds, instead of having a limit to the amount of capital they put in a company, they had targets. We need to invest at least this much in order to make it worth our time. And entrepreneurs said, great, we'll take the money and find lots of ways to spend it. And that's a recipe for poor returns for everybody, the venture capitalists and entrepreneurs alike. So really something that's critically important is building these companies in a highly capital efficient manner. And that speaks to being able to raise money from VCs. So if you can do this in a capital efficient way, then you need to spend less time trying to find VCs to invest in the opportunity.
And not all PMAs are the same, right?
That's right.
Because you can have a PMA where the endpoint is a 30-day follow-up. You can have a PMA where the endpoint is a 6-month or a 9-month, and then you have PMAs that are 2 years follow-up. So I can guarantee you that anything that has a 2-year follow-up is going to get a lot more scrutiny than something that has a 6 or a 9 or a 12-month endpoint.
We're going to have to wrap it here, just given the agenda. We could go on all day with this. So I want to thank our panel for some very insightful comments and a little bit of controversy, which we always like to see. So nice job.